welcome to my YouTube channel, dear learners. Hopefully, you are doing great and fantastic. Well, today I'm going to talk about accounting for management. This is an essential subject for your studying at a university level because it's a part of your curriculum as well, especially for business and management students. So let's dive into the subject. We are going to start from the beginning and to the end of. We will cover various topics, so watch till the end. Let's get started. First of all, it comes to overview. When it comes to overview, it consists the following topics, and I'm going to cover in this video. Hopefully, you watch the video till the end and learn something what I'm going to teach you. Of course, the first it will come introduction. I'm going to introduce the accounting. What is accounting for you? What does it represent? What is going to tell you when it's come to the accounting? Well, because before we dive into the subject, we have to know this accounting meaning, its purpose, and because the theory of the accounting management is essential and obligatory because before you go to the topics and do step by step from the beginning, the theory and some elements, some terms, and some importance, you know, in topics in the theory subject and the theory part of this subject is really essential for your better understanding. Beyond that, you will learn each and every topics because your mind should be clear. Otherwise, you won't understand and you won't understand the other topic as well when it comes to learning of the subject. Well, of course, in important of accounting terms, there are important accounting terms as well. We should know those terms because we have to learn the accounting for management. Those terms are helpful and useful to go beyond those topics as well that will be frequently used in this subject. So better to know. Of course, financial statement. What's a financial statements? The need and importance of financial statements. I will explain about that as well. Okay, then it comes ratio analysis. Well, ratio analysis is one of the most frequent use of the analysis in the whole subject, especially by the managers. The manager should understand, especially account manager, the uh, ratio analysis is so useful for their managing of the accounting. Well, in the ratio analysis, it will count the rationale and utility of the ratio analysis, like classification of the ratio, because first of all, we will understand what's the ratio analysis, then it will come to the classification of the ratio. Each and every ratio, where when it comes to the ratio, has its own types and meaning. So we will dive into that details as well. So calculation, interpretation of liquidity ratio. So, guys, here when it comes to like how many types are there, when it comes to classification, it comes under this classification of the ratio, like liquidity ratio, activity and turnover ratio, of course, the liquidity ratio and interpretation of the activity or turnover ratio, calculation and interpretation of the profit and solvency ratio. Then it comes solvency or leverage or structural ratio. So these are the types. It, this comes under the classification of the ratio. We will dive into details in each and every ratio has its own types. So we will learn the concept and meaning, what does it mean, and what the purpose of those you know um, ratios which are being discussed here. Well, right now we are just I'm letting you know that we will cover these topics, okay? If the video getting longer, we will just learn some few topics, then remaining we will get into new video and I will explain that as well. But until unless I am covering whatever we have right now, until that we should understand those topics which are going to be talk about. Okay, so all right, guys. So here, calculation and interpretation of liquidity ratio, calculation and interpretation of the activity, turnover ratio, calculation and interpretation of the profitability or solvency ratio, calculation and interpretation of solvency or leverage or structural ratio. When it comes to some people, they call it solvency ratio. You can some people say leverage and structural ratio. So these are different names, and you can give that. Well, then it comes advantage and disadvantage of ratio, of course, analysis. What is the advantage and disadvantage, and common size statement analysis. Common size statement analysis is also part of this overview. We will cover each topic here, whatever I have discussed here right now. Okay, let's move on. Okay, first it comes introduction of accounting. What is accounting, right? So, in simple terms, accounting is referred to identifying, recording, summarizing, analyzing, communicating. Well, um, all right, you will understand. Okay, this is what we are thinking about this, right? Like just accounting is meaning of what? Accounting is just refer to identifying, recording. So what does it each mean? What does identifying mean? Recording, summarizing, analyzing, communicating. So all these, has own meaning and one purpose for using. So let's dive into identifying. What does identifying mean? Well, identifying it means that to identify the economic event. What economic event? Economic event where in business organization. Economic event is where the transaction is taking place. What? Transaction is taking place. Transaction of what? Transaction of money. It should be a monetary form. I mean, whatever the consequences happening to your business enterprise, of course, that consist like transactions, of course, the that happenings in whatever the economic events that take place, that should be in terms of money. I mean, monetary form. It should have monetary form. And then if it has a monetary form, it should be measurable, of course. When it is monetary form, then that is measurable as well. So if it is not in monetary form, then how we can measure? So that will not be considered as a economic event. Well, there are conditions for economic event as well. What those conditions? So the first condition is obviously that is called economic events, which is must be monetary form. What? And monetary form. Yeah, when it comes to economic event, we are talking about economic event that should be monetary form. If it's not in monetary, so then we cannot call that as economic event. In the next one, there should be changes, and financial position. Of course, when you buy something, assets, maybe you have the liabilities. Of course, money goes out from you, and or maybe you purchase something, or maybe you sell something. Money comes in, money goes out. This definitely bring changes in your financial position. Maybe your financial position get a strength by the sales. When it come to sell, you your turnover is increasing, so there is in changes in your financial position. And that's what like we are thinking. That's the economic events we can call that, because there is a increase and decrease your monetary and your value to your financial position, your strength of the business and whatsoever. We can say that something is changing and brings something is come changes in your business. Of course, that is what we are saying, the economic events. When it comes to economic events, we should follow those and understand those. Otherwise, you won't know that what is really is an economic event. So you got the economic event, and these conditions should be fulfilled. Then, of course, when we identify this economic event, of course, what we have the next, we have the recording. We are to record that economic event. Well, if we don't record that economic event, what will happen? For sure, we we know that without organizing, without recording, without proper documents, and that you cannot, preserve your transaction as well. So recording is a kind of the preserving and keeping your transaction, um, under the record, and that will really help you. So there are some method we are doing that recording, like recording in journal entries, of course, journal entries. We should record in journal entries, and then we should, of course, ledgers. We have the ledgers posting. When we have the ledger posting as well, we are going to record all the transactions and that take place. And maybe subsidiary books we have. And we have like, of course, cash book. Yeah, you have the cash book in your hand. You should record that in. So of course, when it comes to the bank, there are the bank reconciliation statements. These are what we are taking into consider. These are the method of the recording. By these methods, we are going to record all the transactions which take place inside the organization. Later on, we will understand that we have record each and every transaction. Then later on, it come after recording all those transactions and economic events that have taken place. We have to summarize. What does that summarizing mean? Summarizing is also refer, that all those records and everything has taken place. It should be in proper, in a good form, because it should be summarized. And the summarization could be taking place in financial statement. We will make a financial statement. Financial statement is a summarization of those recording, the identification of the for sure identification of the economic event that has been taken place, and the consequence of that there has been some changes in your financial position. All those we are going to summarize in where in financial statements. Well, those data we have, right? We have recorded that. So here, the summarizing the data in financial statements could means that, what that mean. Financial statements includes like balance sheet. We are making balance sheet, the liability and assets, one side and other side, and we have the profit and loss account, how much we have the profit and how much we have loss. We understand that, and that also considers the cash flow statement, how much cash we have received, and cash flow statement. So these are the three elements we should consider when it's come to financial statement. After that, it will complete our financial statements, and it will bring the summarization of the data that we have recorded. We identify that. Okay, later on, it comes to analyzing. Analyzing is also essential part of the accounting. That is, it after summarizing, we should analyze what we have done it and how our profit and losses, what is we are in a profit, can they our business in a profit or it is in loss. So thereafter we take the decision. Of course, the manager will take the decision after the analyzing their condition of the businesses. Otherwise, if you don't analyze, then how you will gonna know your strength of business and how much you have sold, how much you have lost, how much you pay the salary, how much you rent and everything, all the expenses and all the costs are being analyzed, and whatever you have received the money from outside to your company and you got that, and as a revenue we can say as a sale and whatever that you have, later on you will know the net income and everything, you know uh, then you will know that what is the financial position, what is the strength of your business. So analyzing is a part of that. So manager will take care of the analyzing strictly. So it is done with the help of what? With the help of ratio analysis, versus come ratio analysis. They should do the ratio analysis first. Then it also common size statement, common size statement analysis. Of course, we will talk about ratio analysis. We will talk about the common size analysis and with the details. It will be in the next topic. Well, we just want to understand is that these terms. And then comparative statement analysis. Comparative statement analysis. We should understand these. These are really, important. We when by the help of these three elements, the manager will take care of the analyzing, and after the analyzing, and he will come to know, he will come to know and what's the strength and what's of course the financial positions of the business. Then later on, then it comes communicating. Of course, when you have all done each and every element of here, analyzing, identifying, summarizing, recording, then it will communicate. Communicating, which means it refers that when you have identified everything, you determine, this will demonstrate your financial position. It will talk about your business, of course, the quality and your business strengths and whatsoever that, this will bring the communication between you and your investor, the investors and sh- uh, shareholders, of course, I mean, stakeholders, whoever are playing a key, role in your organization. This process that you have taken place, you have done it, everything will communicate to them. They will finally take the decision whether this will be profitable for me, whether I will gain something or not. Well, investors will understand through the communication of your, this financial position and analyzing and everything through the communicating to your accounting process, and they will understand your position, everything. I mean, regarding to your business. So your accounting will communicate even to the court as well when it something happen, maybe the case filed against your business, against your business, so that there will be a proof. So this proof will communicate to the court for the decision making. So that's what this is really important. This communication mostly uh, say about your business to the other outsiders, for the decision making, for the clarification, and as a proof of evidence and that is in your hand. Well, we understand what's accounting, what does it represent to us, and what does it mean, and what are the elements included here. Now we are going to talk about the basic terms of accounting. Okay, these are the basic terms you should understand before you go to to the other topics, because these terms are used frequently into in this subject as well. Even though in other subject you should, as an accountant, as a business and management student, you should know each and every terms which are essential, because this is your subject and you have to know before to go to it. Okay, let's go. Let's know what are asset, liability, and each and every term. First of all, assets, as it suggests name, that anything that business owns, right? In form of cash, in form of equipment, in form buildings, etc. You know, then equipment is come and cash it comes and buildings it comes and everything. You know, there are various equipments and buildings and cash, whatever anything a business owns, that's called assets. And then it comes liability. Liability, business owes to others, loans, accounts payable. You know, that is like when a business they purchase something, they are unable to pay money. They should pay money later on. That is what a kind of liability. Loans, you are taking a loan from the bank, and you will pay the loan plus interest. That is also your liability. You have to pay after a certain time. And then equity, it is called equity is called the owner's shares in the company. Of course, what does it mean, owner shares in the company? It means the assets minus liability that will come to owner's share. When you have asset, when you have liability, liability, you know the meaning of liability, that owes of the business. You know, as I said before, this is owes of the business. Accounts payable is owes for the business, and these are called liabilities. When you pay the loans, when you pay your expenses, when you pay everything, you know, and that remain, um, you know, what in assets and minus those O's, and whatever remain, that is called the owner's shares of the company. And revenue incomes, money earned by the business from the sales services. Sure, when the money comes from the services, from the sales, then it is called what? Revenue or income. Of course. All right, guys, come to expenses. Expenses, cost of a business has to operate. Like when you don't have expenses, you can't operate. You can't operate. You should pay the rent. You should give the salary. You should utilities. So these are expenses. These are the costs of the business. You have to do that. Without these expenses, you can't do anything. You don't have any option, and so the cost is required to be paid for your businesses. So that's called a cost and expenses to your business. And you know there are various expenses, but these are two or three are the important one. So profit, revenue minus expenses, of course, minus and expenses when it comes to revenue, and minus expenses, then it come what? It come to profit is equal to profit. When, of course, minus expenses also called a net income. For sure, all the expenses, all the costs, when you minus it, later on we include interest, including your other expenses, costs, everything. Of course, that will come your net profit, your net income. Loss. What is loss? Loss is when expenses are more than your income. That's called what? Loss. You have, purchased a car for sure. Maybe you are doing a business for your car company. You are maybe you assemble that in your country. The part of the car you bring to your home country, and then you gonna assemble that later on, after everything you fix it that car, and you're gonna go for sale, and you came to know that my expenses has been more than what that I sell, and the income is really less. you will calculate each and everything from the point of the beginning of your business to the end of the sale, and you take the money and you earn the money from that sale, and that is what any form of your business, and that's what we are thinking about that, and it will be your expense and then income you got it that later on you come to know that my income is less and expense has been more, so that's referred as a loss. And let's come to the balance sheet. What does balance sheet mean? A financial statement showing assets, liability in both the side, you know. Of course, balance sheet shows the assets and liabilities and equity. Sorry, that's another form of that. And right now the balance sheet is only they're talking about the showing the assets and liability. Asset, we will know what's the assets. Of course, we knew the assets before that here. And liability, we also talk about equity. We also talk about, asset. It can be a current assets and non-current asset. Liability also we can call current liability and non-current liability. Then current liability, current asset is only, is used for 1 year. Maybe that asset is only used for your current time. It's not, take not go beyond the 1 year before. If it goes, beyond the 1 year, that's called non-current asset. Liabilities also for the time being, and for maybe for 1 year. Within 1 year you use that and you pay that owed for within 1 year. Then if it takes too longer, that's called non-current liabilities. And equity, as I mentioned and before we talk about that. Okay, income statement. What does income statement means? A report showing income expenses over the time or a period of time, 1 year, maybe income statement, maybe 6 month, quarterly, yearly, maybe annually, of course, or maybe monthly. So that is income statement is showing both the showing the income. Of course, here's the income. Sorry. Well, income statement, we understand that report is showing the income and expenses over the period of time, like maybe monthly or maybe yearly or quarterly, whatsoever. The kind of report that show everything over there. So that's the call income statement. Our income would be there, our expenses would be like we are writing each and everything over there. Later on, we understand what's our net income as well. Okay, guys. Let's move on, and there are many more terms we should understand before we dive into details. Well, cash flow, movement of the cash, uh, in, inside and outside of the businesses. That's also important. And so the cash is coming and going, the business. Of course, the cash flow is coming to your business. Cash inflow, cash flow. There can be two types: cash inflow, cash outflow. Cash inflow, which business come in, cash inflow, and cash outflow, which from the business the cash is going on. So, which means the movement of the cash in business. Account receivable, of course, the account receivable money owed the business by the customers, for sure. Money owed to the business by the customers. The customers should receive, to pay to the business, and that's what, that they receive the money, and that's it will be to read into the accounts and receivable that is received by the customers. Account payable, the money, the businesses, the business owes to suppliers, and they pay to suppliers their money to, because they will give the money to others, because they pay to the suppliers because of their paying of that capital. What's the capital? Money invests the owners of the business. That's called the capital. When you start a business, maybe you start any sort of business that could be any form. Maybe you are making any educational setup, center for teaching of students. You will invest money, $10,000 or $5,000, and you purchase all the assets, and then you prepare everything for that. That's the initial amount of your capital. Then later on, you will calculate that, okay, after a certain time period, how much I will return, I will gain because of this initial investment. This initial investment is called, capital. Inventory, goods available for sale. Whatever the goods you have stocks in your hand, that's called inventory. Depreciation, reduction in value of the assets over time. What does it represent? Depreciation, which means the reduction of value when it's come to the assets over time. Well, your asset, like for example, you have purchased a car for your business, and that business is use that car. So for over the 1 year period, that reduce the value. The value it decreases. So that reduction in value and measured in terms of money is called the depreciation. So we will understand that as well. Journal entry. Journal entry is a record of the transaction, accounting of the books, and as I before said that I record the transaction and for accounting books, we should organize and manage and everything, but record properly and appropriate so that we can do summarizing of that through the financial statement as well. Ledger, we have this ledger, a book of system where all accounts are recorded. As I before said that in journal entry and ledger, we have to record everything properly and appropriately so that logically communicate to the others as well, and that will create a better summarization and to financial statements or trial balance, the summary of all the accounts check accuracy that we have done in ledger entries and everything. Is it the correct or not? And so if we have the trial balance, we should see the accuracy and correctness of those records. And accrual mean the recording of revenues or expenses when they happen, of course, not when paid. Of course, what does it mean? It means it refers that, for example, if A, B company, they want to buy a machine, a machine, but they are obliged to pay after 1 month, you know, after 1 month, they are going to pay money of this machine to C company to see to see. This see what he's doing. He is doing making accrual, accrual recording of that. He will take that returns, after 1 month, but the money is not has been paid to the C company, and so C company is going to record that expense, that revenue that um, he's going to gain, that will going to be paid by the ABC company because of the purchase of the machine. Simultaneously, when the C company he is going to purchase something, of course, he will increase, his expenses will increase, right? When expenses increase, of course, he is not able to pay right now. The payment is pending, of course. He's going to record this that I have purchased this and the payment is not yet done, that's due. And later on, after a certain time, he's going to pay that. So that recording is a basis of accrual records. So that's also accounting is talking about that, and accounting will do that in accounting. Double entries is accounting. When it comes to double entry, then it's talking about the transaction. Every transaction has a two sides, debit side and credit side. On the basis of that, we are going to record all the transaction. So you have to know, you understand all these terms which are essential and a part of the subject. This is better to know before we dive into the details of those, and because the terms are usable in each and every year. So now we are coming to the financial statement. What does the financial statement means? The financial statement here It's talking about the financial statements. Is the end product of the financial accounting, and which is prepared by the accountant. Of course, after certain time, after doing each and everything, you should, recording, class, making, analyzing everything. Then there is summarizing, each and everything later on. You have done it all those steps before I explain that. Then you have the financial statement. You have to prepare that, and that is the end of the product. Financial accounting is prepared by the accountant. Financial statement is referred to the set of reports like schedule, and that will be prepared by the accountant at the end of the year, of course. So there will be so many transactions during the financial year, so which has been occur, and it will show in the financial position. That will show your financial position. A business enterprise, the businessman instead of um, is enterprise at the last days, like means the financial worth of a business. What does it mean that? Which mean when it's come to all the transactions is being taken place, all those will be recorded in the business at the end of the year in the loss of. So that will show the worth of the business, the business worth. What does financial position? The financial position mean the worth of the business. What's the worth of the position business? When it comes to like financial position, and it's showing through by your strength and financial position. So that financial position means the worth of the business. If you have a good financial position, you have a good worth of the business enterprise. So that results show the results of the operation, like you have done it in a profit and loss account. You have done in the profit and loss, how much you profit you gain, how much loss you have occurred. So how much is on owes, so you will have to be shown that by the financial statement. Everything you should be paid to that. And if you have losses, you will identify that, and definitely you will understand the consequence of your business transaction and the profit. You have gained the profit, you will understand, come to know what was my profit I have gained through like this business operation. So that will be identified definitely through the financial statement. Financial statements is a consist of the following: balance sheet. Sure, this is balance sheet. It consists of the financial statement and profit and loss account, cash flow statement, statement of the changes, equity. These are the elements that are being part of the financial statements. All explanatory notes and above, as I have mentioned here, the part of from the above statement, the board of directors, of course, may prepare additional statements or report that provide additional information to shareholders, or that they can prepare true and fair view of business enterprise, and that there are many users and they will take decision on the basis of the true and fair view of financial statement of the company. Well, as I say, these are the important part of the financial statement. Financial statements include balance sheets, profit and loss account, cash flow, and statement of activity, and all these are the important additional. The manager will also prepare these. Apart from these statements, the manager will also prepare additional notes, and the board of directors prepare everything that they have in their hand to show fair and true value of their business to the shareholders, to stakeholders, and maybe to the investors. Many of those users, they will take the decision to find out whether they are going to uh, going to invest in this company on the basis of those evidence they have got, and they understand the worth of the business. So later on, they will see the fair and true value of the business, and they will take the decision to invest in this particular company. So I think it's enough, because it's getting more and more, because of that. I appreciate for you watching this video until the end, and hopefully you understand something from me. And these were the most important part, of the business. And of course, because you start a learning of this subject, you should know this. Hopefully you understand everything. And thank you for your watching. And of course, hit subscribe and likes button if you like this video and you understand something. Hopefully you will learn and you have to understand. You have got something from this video. And stay tuned for the next video. I will come back and we will talk about the remaining topics as I discussed in overview. Thank you so much. Bye bye. Have a good time.